Hello and welcome to 5-Year Club video number 325. An interesting article today in the Wall Street Journal. Bogle sounds a warning on index funds. The father of the index fund, says it's probably only a matter of time before they own half of all U.S. stocks. I do not believe that such concentration would serve the national interest. There no longer can be any doubt that the creation of the first index mutual fund was the most successful innovation, especially for investors, in modern financial history. The question we need to ask ourselves now is, what happens if it becomes too successful for its own good? The first indexed, I like saying indexed, but it's never indexed, it's just index. The first index investment trust, which tracks the return of the S&P 500 and is now known as the Vanguard 500 Index Fund, was founded on December 31st, 1975. It was the first product, as it were, of a new mutual fund manager, the Vanguard Group. And we're stuck behind a paywall. I am not a Wall Street Journal subscriber. $1 for 2 months. Let's see what these membership options are. You can see my reaction to Wall Street Journal pricing in real time. All right. So all I care about is the all digital access thing because I really don't need to destroy any trees or build up a bunch of Wall Street Journals, and I don't have time to read them anyway. And $1 for 2 months, and I can cancel anytime. Okay. Or $20 for 6 months. That could be good. Of course, this probably renews at like the big monthly price. Or 50% off 12 months. Wait, but this is $20 a month. There's no way I'm going to pay $20 a month. I don't even pay that much for Netflix. Anyway. Yeah, so cool article, but I'm not a Wall Street Journal subscriber, and their pricing is too rich for me. So instead, I found a Market Watch article with, I think, similar ideas, just a little bit older, June 1st, 2017. I don't think this is the first time that Mr. Bogle has discussed this opinion. John Bogle has a warning for index fund investors. He's also known as Jack Bogle, FYI. If that's the... oh boy. Let's see, Bogle. I don't see the word Jack here, but yeah. Jack, John C. Bogle. I've heard him both. All right. He looks very earnest. All right, so this is in Market Watch by Conrad de Anye, maybe. Even indexing can be too much of a good thing. The tragedy of the commons is a fanciful term from economics that describes an action whose benefits accrue mainly to the entity committing it and whose costs are diffused. A typical example would involve a manufacturer polluting the air or water. But the expression can also apply to ownership of index funds in the commons that are the financial markets. What makes indexing a tragedy of the commons is that the benefit, higher long-term returns due to lower costs, only accrues as long as there is an active functioning market underlying whatever index a fund is trying to capture the performance of. While investors and managers of index funds reap the reward, the expense of maintaining that healthy market is borne by shareholders in actively managed funds and traders who buy and sell individual stocks. Now, why is that true? Well, that's true because when you buy the entire index fund, you are buying each member of it according to their current market capitalization, which means you're not giving any opinion on what you think the price should be. You're not driving the price of any of them up. You're not driving the price of any of them down. And equivalently, you're not rewarding particularly valuable companies and punishing less valuable companies because you're not expressing any opinion about it, about the future returns of any one company relative to the others. But people who are buying and selling individual stocks, obviously, they are setting the prices for those stocks, and you need healthy prices. You need companies to be punished for bad earnings and rewarded for good earnings in order for the index fund to be meaningful. The more investors index, the greater the cost for those who don't. The market cannot exist without those participants engaging in research, analysis, and the transactions that result from them, as well as regulation of the market itself and the business whose stocks form it. Index fund shareholders largely avoid the costs involved, so the more investors index, the greater the cost for the ones who don't, increasing the incentives to index. John Bogle, the founder of the Vanguard Group and the person who ignited the trend toward index investing 4 decades ago, acknowledged recently that this circle could turn vicious eventually and cause downright tragic events in the stock market. If everybody indexed, the only word you could use is chaos, catastrophe, Bogle told Yahoo Finance at the Berkshire Hathaway annual meeting last month. The markets would fail, he added. Bogle noted that trading would dry up if the stock market comprised only indexers and there were no active investors setting prices on individual issues. Everyone would just buy or sell the market. The market is not entirely owned by indexers, of course, and it never will be. And Bogle pointed out that as indexing increases to a certain point, it opens opportunities for active investors to exploit inefficiencies in the pricing of some stocks. But past that point, whatever it might be, somewhere beyond 75% in his view, the market could become a dangerous place. Bogle did not elaborate in the interview, but as indexing comprised an ever larger proportion of trading, the limited trading of the few remaining active market participants would cause exaggerated price swings in individual stocks and perhaps the whole market. Bogle stressed that there is a long way to go before indexing reaches a level at which market stability begins to crumble. About 1/4 of U.S. stock ownership is done through indexing, he told Yahoo. According to investment researcher Morningstar, 46.7% of assets invested in the U.S. stock markets via exchange-traded funds or mutual funds was indexed in April, compared with 36.3 3 years earlier. Wow, that's pretty dramatic. That's pretty dramatic. In only 3 years? One development could mitigate much of the advantage that index funds enjoy and slow the rush to own them, but you're probably not going to like it. When the market suffers a prolonged decline, active managers can gain an edge over indexers by moving large portions of assets into cash or into defensive sectors such as utilities and consumer staples. Shareholders of index funds could then suffer more than owners of actively managed funds, and they could take their losses harder due to the perceived security they feel precisely because they merely own the market and aren't trying to beat it. That might make active investors feel a bit of schadenfreude for indexers who have been free riding at their expense. But the feeling probably wouldn't last. The greater price swings that could ensue in a heavily indexed, less active market are likely to exacerbate losses for everyone. Until the next bear market, the indexing trend is likely to accelerate. As with any tragedy of the commons, indexing is the sensible thing for each individual to do, but each individual should remember that many sensible ideas, especially in investing, make less sense as more people put them into practice. When the stock market turns down again, index fund owners will have to become their own active manager and make sure they're well diversified with limited exposure to risk, chaos, and catastrophe. And that's the end of the article. But see, it doesn't say, that's kind of vague, right? You're going to have to make sure your stuff is good. Well, you'd have to do that anyway, so it's not particularly meaningful. Anyway, I just thought the idea that kind of irrationality and volatility would increase as index fund ownership increased. I thought that was interesting. I also wonder if there will be some like what kinds of systems will develop in order to exploit the market inefficiencies associated with increased indexing, with fewer participants doing research and trying to buy individual stocks. I don't know. Maybe we don't need as many researchers. Maybe artificial intelligence will automate a lot of those analysis jobs away. Who knows? But also maybe not, because companies are more than the sum of their, data parts. All right, well, that is it for video number 325. Hope you enjoyed it. Hope you enjoyed this warning by John Bogle. I am going to remain invested in indexes, and I think you probably should too. Have a fabulous evening.